We have quite a few catalysts coming in today, in addition to Jolts job numbers for the U.S. for the month of April. It's pretty interesting, the turn of events today, as we started to see the market continue to just melt up against all odds of every reason for the market to come down. Nevertheless, it finds a reason to continue going up. Today we had the Jolts April numbers, and this is basically the number of job openings that are available. It's more like hard data, as this is actual real data that is out there for job openings in the U.S. But nevertheless, the numbers did come in a lot better than the market expected, or at least consensus expected. The estimate was 7.11 million job openings available, and then we got a 7.391 million number of jobs available. In addition to that, last month's numbers were actually revised upward to 7.2 million, with just about a 10,000 job adjustment. So it's not really a whole lot. But at the same time, it is showing a bit of strength when it comes to job openings in the market. Now, let's take this with a grain of salt, only because these are just job openings, and it is a survey that's done by the U.S. Labor Statistics. It doesn't exactly define how the job market or the employment market actually is, but it does kind of set a little bit of a tone that there are more openings that are available. But again, these openings could be just either ghost openings where companies are trying to keep the requisites open, make it look like they're hiring when they're actually not, or maybe just older openings that are still out. But the jobs that could start within 30 days are the only ones that are listed here. So let's continue to look at the impact of this data. More importantly, though, we have the ADP data coming out tomorrow when it comes to the ADP employment change. On Thursday, we have, of course, the initial jobless claims. And then Friday, we have the ADP non-farm payrolls, which is, of course, the much more important figure. And we also have the unemployment rate as well. But overall, what I am seeing, in addition to the GDP forecast for the Atlanta Fed, is that the economy is a bit resilient, right? So everyone thinks the economy is going to crumble and fall, but at the same time, it doesn't. And the thing is that the economy isn't booming anywhere like it was in 2020 or 2021 or even in the early 2010s. The economy is actually just stabilizing in a sense. But the thing is that economists out there have been predicting a recession for quite some time. So when you have all these economists basically saying the economy is going to slow down, and they come out with downward projections in terms of data that's coming out, and the data comes in on the upside, and the upside doesn't even have to show any type of extreme expansion or extreme job availability or anything. It just has to beat expectations, because the expectation is what the market is pricing in. And when that number comes in stronger and shows the economy is more resilient, it basically tells the Fed, in a sense, that, hey, we don't need to cut rates or we don't need looser monetary policy because the economy is just doing just fine and the job market's fine. And inflation is still a little bit up there, but it's a little bit sticky. So in that case, we don't need to cut rates. We don't need lower rates to stimulate an economy because the economy is doing just fine the way it is right now. And also, on top of that, there is the overlying notion that tariffs are going to come through the door, which I believe the market is actually pricing in, that there's going to be more deals coming in through the door. But that could set I wouldn't say a strong inflation effect, but a much more subtle inflation effect on the market. But I think that might be just seeing the information that's coming out. I think that might be more than what the market expects. But the enterprise will figure out a way. They'll figure out a way anyhow. But either way, if the economy stays strong, the earnings stay strong, it just shows that the companies excuse me, it just shows that the companies are still able to find profitability in expanding their margins or keeping margins elevated while taking in the hit for a higher import cost. But at the end of the day, if these countries are working to create deals to, let's say, minimize the amount of tariffs or make exception to tariffs, then that could still lead to prosperity. So with that being said, TLT is basically flat in the day. It's coming down from its recent highs that it had last week around the 86.5 mark. Still down a little bit from there, but the more important part when it comes to TLT or yields is that the market doesn't like the huge volatility swings to the upside when it comes to yields. But it is okay when there's stabilization in yields. So what we've seen was that the 10-year is basically floating around 4.4 to 4.6%, and thus it's not showing any massive moves to the upside or any type of rampant inflation or very tight job market. It's just really staying around this area, and that's okay for the market. The market is okay with that, and we've seen that it's okay with that. If TLT goes all the way down to $80 and the 10-year goes all the way up to 4.75% out of nowhere in a very short period of time, well, that's not going to bode so great for the stock market, because then there's going to be instilled fear that it might run rapidly higher. But if we get rates to stabilize, the market is actually okay with that. So against all odds, these companies are able to still run their earnings even on 4.5% rates. But if we start to see rates for the 10-year climb up to 5%, and we see the 30 and the 20-year around 5.5%, that could mean a little bit of trouble, especially when it's actively heading in that direction. So we'll see. There's really no way to tell exactly how the market's going to react. But as a general point of view, I think the general sentiment of the market is starting to swing back to the bullish side. However, there is an underweight exposure to the upside in terms of the market for a lot of hedge funds, but that is actually starting to come to the average area where the NAIM index exposure is like around 85 or 90. When that gets all the way up to close to 100, that's going to show that, okay, maybe we're coming to a bit of a tipping point where these hedge funds need to de-risk a little bit. But as far as anything goes, I think we're going to be seeing all-time highs a lot sooner than people expect. And with that being said, probably a bit past that as well. It's very hard to be bearish this kind of market right now when you have just a wall of worry for the bulls to climb. I mean, that's what bull markets are, right? They climb a wall of worry. And when you continue to see this never-ending loop of pessimism on the market does take advantage of that opportunity to just continue going back up, right? That's a great setup, in my opinion. So for me, I have been long. I've been long and strong, all right? I've been swinging calls and short-term calls on certain companies, certain stocks that have great setups. And overall, I'm not necessarily looking to build a huge cash position right now because I think it has a bit of upside to price in. And I actually think that the market could possibly see S&P 500 at 6,500, even 7,000. Maybe this year or early next year, perhaps. At the same time, that would mean the market would be running very hot in very overvalued territory. So I don't expect it to be a straight line, but I do continue to see the trade deal issues happening, but not to a certain extent, like basically to the point where the market's looking past the issues and kind of realizing like things are going to be good. I do expect a little bit of a bumpy ride this summer, possibly, but not anything to a massive degree. I'm probably going to start reducing the amount of short-term exposure that I'm running on my book, but at the same time, still pretty much staying long the companies that I haven't really made any huge buys pretty much since the April lows. And I mean, that's the way it's been. Like, I don't think now's the time to really go all in the market if you are not already all in. I mean, if you are already fully invested, by all means, like there's no reason to like sell everything or whatever, try to predict a recession, because you're going to have a much harder time predicting a recession versus just betting on the upside most of the time. Markets go up 90% of the time. So why bet on that 10% when even the greatest economists in the world can't even predict a recession? Like, what makes you think you're any better, in my opinion? And that mindset is going to save you from a lot of stress and a lot of drawdown or missing the upside. What I would say is that if you spent the last 3 years trying to predict a recession, that is one thing. But if you spent the last 3 years preparing for a recession in terms of your portfolio, you have definitely missed a lot of upside. And at that point, you might need to rethink how you're doing things, right? I mean, if you're tactically shorting certain things, then that's one thing, then you're probably doing just fine. But if you've overall been sitting out of the market hoping for that grand old dip, I really don't know what to say at that point. You got nothing coming to you, because then when that dip actually comes, you're probably not going to buy. And if you didn't buy the April dip and you're hoping for a dip, then it's very likely you might be waiting for some time. And in my opinion, again, when that dip happens, you're probably not going to buy because you're going to think it's going to go lower. So with that being said, when it comes to the macro perspective, I think things are going to be heading in the right direction, and I think the market's going to continue to melt up. As I've been saying, since the S&P 500 was around, I think it was like 5,600, I've been saying that this looks like a melt-up situation. It looks like constant pessimism that the market is going to revisit the April lows, and then from those April lows, now it's like we need a correction. And then from there, that story is going to keep coming over and over and over again. Like, don't get reeled in by this bear porn, okay? Like, just go long the companies that you like and that you're convicted of. That's all it takes. You don't need to set up or be all in cash or 50% cash, because then you're going to be hoping for a pullback. If you go long the companies that you like, then you can go long most of it and then buy more if it comes down. Or you just buy a little bit every single week. But until then, you are going to be sitting on the sidelines hoping for the market to come down, and you're going to be frustrated every single day. Now, again, I'm not saying to go all in the market. I'm just saying that, be cognizant of your environment. If everyone around you thinks there's going to be a correction, there is a very small likelihood there will be a correction. So just saying that for a lot of folks out there who might be thinking that. Now, rates are a different thing, okay? I know I've said for probably very recently, not that long ago, that I think rates are really going to stay between 4.3% and 4.6% for the 10-year. And I still stand by that. I'm not sure what the upside in TLT is going to be, only because the economy is much more resilient than the market expects. And inflation is coming down, but it's not dropping down dramatically to the point where it's giving the Fed a green light to cut rates. And in fact, I don't think we're going to get more than 2 rate cuts this year. I think maybe 1 rate cut, if anything, or maybe 2. But the market is pricing 2 rate cuts. They are pricing a nearly 100% chance the Fed is not going to cut in June. If you look at the CME Fed tool, it's saying that there are 2 rate cuts priced in this year. Unless we get a drastic issue or slowdown in the market, all right, that is going to stay around 2. Unless housing collapses, that is going to stay at 2 rate cuts. If housing continues its downtrend, then of course it's not going to change to 2 rate cuts. But if housing deteriorates faster than the market expects, it will be more than 2 rate cuts. It has to completely miss expectations. The market is okay with it missing just by a little bit, but it has to surprise drastically. Because if you're not surprising the market consensus, it's not going to change much than it is today. You have to surprise consensus. Yes, the housing market is not doing well. The housing market's in a bear market. But at the same time, if the market is okay with that, there's no way they're going to change their mind tomorrow unless new data comes in and change their mind. And that could change my mind too. But until that happens, I cannot have long call exposure to TLT for a short period of time. My calls were for 2026. I had to get that move very quickly in order to capitalize off that move. If that move doesn't happen quickly, I could still be right. TLT could still move up. But if it moves up in October, I'm toast. All right? That was the reason why behind the strategic position of cutting the TLT spreads, because of that reason. So be careful out there, guys. That's all I can say. Know your conviction. I'm just some guy talking on a mic. But if you're convicted, that's a completely different story. Your real conviction is learned and earned. It's not borrowed. Borrowed conviction is going to get you in trouble. So make sure you do your own due diligence and research. So with that being said, we got a couple of news that is happening this week, in addition to some news today with some smaller companies. EOS Energy, ticker symbol EOSE. They're going to be speaking today. The CEO is going to be speaking today during the Stifle conference as well. In addition to Navitas, I believe they're supposed to be speaking today as well. Navitas is actually up about 15 to 16% on the back of basically the market being back in risk on. That's all I would have to say. I mean, yeah, they did have news that they're going to be partnering with Brightloop for a next-gen battery for heavy transportation and agricultural products. But at the same time, NVIDIA did partner with that, and it's giving its catalyst. So if NVIDIA is moving up, this is likely going to move up as well. Nebius Group, they are bouncing back from their big down day yesterday morning, and they are green again in the rolling 5 days. So, congratulations to Nebius shareholders. As a preface, I do have a small spectrum position in EOS as well as Navitas. And Nebius, you guys already know, I have a decent sized position in that one as well. Tesla is having their robo-taxi launch in, I believe, Dallas, Texas, or Austin, Texas. I forget which one, on June 12th. So that's going to be pretty exciting. I don't know how that news is going to react. But I mean, they're just doing things. So you guys already know I put on a Tesla position. I think it's going to hit 500 before it hits 300. But if anything, that's probably more of a trade. Haven't really decided. I'm probably going to FOMO trade or panic sell when it gets to near 500, and it's probably going to run to 1,000, and I'll be screwed over. So whatever, it is what it is. But anyway, still holding a Tesla position. Meta is on quite a run lately, on the back of announcing that they will fully automate AI workloads in the near future. I think that the news is just new. Of all the Mag 7, I think this is going to be one of the best performers, in my opinion, in addition to NVIDIA. Well, actually, I take it back. Netflix is just up and to the right. Netflix is just a monster. That just keeps going up. Amazon, my largest position. So this has just been a laggard in the portfolio, to be honest, and it really holds the portfolio back. It honestly does. And a lot of it really has to do with the tariffs, right? So even though they're the largest hyperscaler in the world and most of their revenue comes from, or not most, but a lot of their revenue comes from AWS, and AWS is one of their most profitable businesses in addition to advertising. The market is just looking at tariff impact. So, I don't know, maybe the market's pricing in something for its earnings coming up in July. We'll see. But still staying long, Amazon. It's just, I don't know. I don't think I'm going to do anything with it. Not really leveraged long in it or anything. They're just shares, so just holding on to that one. But yeah, and Robinhood is actually supposed to be, well, the S&P 500 is having a rebalancing after the close on Friday. Robinhood is possibly a candidate for that. We'll see. I'm not really betting into it, hoping that it'll go up. I have some short-term calls that are doing really well to sell probably before that happens. But you guys do know I do have the leaps or the spreads for Robinhood, which are doing really well. These are the Hood 2027, 70, and 100 calls. They are up 90%. Phenomenal. Phenomenal performance. Overall, the portfolio is up over 20% year to date. It is doing really well, mostly attributed to a lot of the short-term stuff that I've been doing. And I'm not trying to shoot for the moon for a lot of this stuff. I'm taking profits as it sees or rolling into longer dated calls if I need to. But I would say I'm mostly in shares, guys, to be honest. Like I am playing some short-term calls. I have some spreads and stuff, but it is not more than 5% of the portfolio when it comes to leverage. I am not trying to shoot for the hills. I think there's probably a chance that the market might have a correction at some point, but I don't think it's going to happen while people are bearish right now. I think it's more inevitably going to go upward versus downward right now. So we'll see. But at the same time, the software is doing really well. My portfolio is software heavy, cybersecurity heavy. CrowdStrike's at its all-time highs. Rubrik's at its all-time highs. You guys are following me with that one. That one, I've been long since 33, and I think I've been pretty vocal about that one. So I hope you guys are able to catch that one. Astera Labs is almost at $100 again. Mercado Libre is at all-time highs. Lemonade is doing really well since the lows. Nebius is doing really well. Axon is near its all-time highs. AppLovin is heading toward its all-time highs. I mean, it's just, there was an opportunity in April to buy. And if you missed that opportunity, I don't know what you would be waiting for, because if you're waiting for another opportunity like that, those don't come very often. They're very rare to happen that quickly and very rare to come back. But we are in a much different market than we were back then. So just keep that in mind. If you're hoping for another 20% pullback. I mean, it might. I'm not going to say it's not going to happen, but we were just there. We just had a 20% bear market, not on a closing basis, but the Qs were in the bear market. IWM I think that thing is still in a bear market. It was a nasty day. Intraday, S&P 500 was in a bear market, but it did not close in bear market territory. The lows closed 19% below all-time highs. So, that rarely happens. We haven't had anything like that since 2022, and it's just the economy is just resilient. So be careful, guys. But other than that, just stick it to it, guys. Like, earn the conviction. Like, learn about these things. Don't just follow people. Just learn about it. You'll find much more success when you do that. All right. Well, that's it for today, guys. Hope you enjoyed it. Take care.